what's going on? It's a beautiful Saturday morning with you, and you saw Max Payne to the T with your own two eyes. Apple expired 400 spot something, and you couldn't have written this story any better for option writers. This blue line is the calls. Picture all this completely worthless, and on the 405 on this way for the puts, completely worthless. The only liability left on was this small leg for calls and this small leg for puts. So expired right here. Picture perfect. This week I'm going to do a more trader-centric, hopefully answer a lot of questions or give a lot of trading ideas. There's plenty of past videos why this is buying pressure, why is this selling pressure, why is this happening. And so getting to that, on Sunday night going into Monday morning, I was saying, definitely not starting off the week looking too good. So here's a screenshot of Sunday evening going into Monday's trading. Remember last week how you had the 375 puts were 11,000 open interest and the 380s were 11,000 open interest also. And I had the arrow going higher. That's a great sign. You want no calls. People love buying their calls on Apple, and retailers are kind of doing it to themselves, not unknowingly. You don't want to sell any, or you don't want to buy any calls on Apple, or you don't want to see any. So the opposite's true on a much smaller form. You had this big hurdle for Apple to get over, and then the highest open interest on the 420, big hurdle to get over with almost no puts. And so let's see what happens on Monday's trading. Go to this chart here. And so on Monday, what do we have happen right here? Get up to 409 and then never looks back, comes back down to 395, 400 area. And so right here, 405 or 410, I wonder why, and comes back down. So let's see how we can do some trading and go through the week with you. Real quick, I wanted jump over. These arrows are for I sell a lot of options, so I need to know where will Apple not go below. Apple will not go below this arrow. Apple will not go above this arrow. And so as you see, the 405 is actually the highest open interest by about 30 contracts or so. I'm not a computer. I don't care. It's kind of semantics at that point. I'm going to use this 410 as my highest open interest because I need to have the highest probability. I need to have a high degree of safety. So I'm not going to care that, oh, nope, this is the highest open interest. You got to use that. No, I'm smart enough to know and make, decisions. So I'm going to always go with safety because say Apple finishes as 406 and I just went from 100% profits to 0% profits. And when I can just make a little bit less but have a high degree of certainty. So that's why if you'll see me, have it not exactly on the highest open interest, that's why. But I'm definitely not going to, have it like down here or anything. It's always a good sign too, like it's not for the bulls when you have this many calls, but when you're selling out here, because you have this as your first kind of bodyguard, this is your second bodyguard, and then you're selling the third one. Like that's a lot of shares for Apple to eat up and eat up and eat up and keep going up. So it's kind of a good thing when this is like really flatlined, and if you sold out here, as opposed to just this. Like you have, you have only one bodyguard too. Like now you have 1, 2, 3, and say this kind of kept going out, and so it'd be even more strength. So that's why I'll do that. But let me go back into, I get a lot of questions on, yeah, but these strikes change sometimes. And that's why you got to let the open interest build up. I mean, higher the better. But when you're doing these weeklies, you kind of start running out of time. So you kind of just got to jump at times. And the open interest, it does change. It kind of starts to pretty much get set on a Tuesday or a Wednesday, depending on the week, depending how much volume's trading and whatnot. But what will normally happen, like say, so this is Monday's open interest, and say Apple gets up to this 410 area, and you're like, oh, I am bearish. I don't think the market's going higher. So that's great. So sell this 420 call spread, or let's just, for ease of use, say you just sell this call. So you can do a call spread or just you're selling the call. And now Apple comes up here and then bounces off and comes all the way back down. Well, let's see what happens. This is for Wednesday's trading now. The 410 established its highest open interest, and not many more people bought these 420s. You know, it's 5,300 or so as opposed to 4,800. So it didn't change very much. Why it didn't change is because Apple got knocked down from this 410 and went this. So people weren't buying the 420s anymore. They were buying the 410s. But you sold out here on this 420. So you're completely fine. You just want Apple to finish under 420. So you don't care if the 400 becomes your highest open interest, the 390, it doesn't matter to you. So it usually changes in your favor because what happens is you sold here and then say, let's just do a hypothetical, say the highest open interest is 390 and 420. And then Apple comes up to this 420, gets knocked down, comes this 390, gets knocked down. Well, what happens, and say you sold this 390 puts, and say you sold the 420 calls. Well, since Apple spends it was over here and spends all its time right here in the middle, now the 395 will be your highest open interest. Then your 400 will be your highest open interest on your puts. Same thing with the calls. Well, now your 410 will be your highest open interest. Now your 405 will be. So it kind of closes in on itself because it comes up to these resistance points and bounces off. Comes up, bounces off. And so it's always going to be in your favor if you're selling options. So the open interest changing strikes isn't really a big deal. It's not like it comes up here, blows through this. Now it comes up to the 420, blows through that. Now it comes up to the 430. It's not going to be really a big deal. So I don't really worry about it too much. So let's go into some trading ideas here. Let me just go so I don't have to switch through those charts so much. So here's what Friday OPEX looked like. And on the simplest form, these are going to be your buy points, sell points. So Apple, here's just a quick chart kind of. Apple went up this 409, came down this 393, and then pre-market down here 391. So if you don't own any stock whatsoever, when Apple got up to that 410 area, you're going to want to either short the stock, buy puts because it has a high degree of probability of coming back down. So let's say you bought puts. Well, this is kind of your line where this is the sell side and this is the buy side. And this is a strong buy. This is a strong sell. These aren't points where Apple is, going to get to. It won't go lower. It's not saying it will get there. So say you bought puts, and here you maybe get rid of a quarter of them. Here, get rid of another quarter, and then play with the house's money maybe, or get rid of all of them. If it comes down here, you definitely would want to be out of 100% of the position. So Apple came down to this 393 area. So let's say you got out of that. And now you're clean slate again. Well, this is a strong buy. Anything under it is a strong buy with the exclamation point in bold 36 font. Like you are just very high degree of probability. So Apple came to this 393. You're going to want to add even more to your position because very high degree of probability it's going to be coming to this 395 at least. And remember that pre-market, how Apple's down here at this 391? Anytime you get that pre-market, it's such a thin market, you're going to want to grab that stuff up, especially if it is way under this open interest. As you see, soon as it open up, rocket right back over. And so that's almost just free money type thing. So on a simple form, gets down here, buy the stock, and then sell half of it here. Sell 3/4 of it, and then be out of 100% of your position no matter what up here. And again, these aren't, it's not saying buy here, sell here exactly. No, it will maybe end up here, might go up here. It's the range, but that's how you can use it. You can also use it in a very conservative way. Apple's here at this 395, but you're nervous. So buy 100 shares at 395 and sell a call at the 395. So, and say you sell that call for $5. So really your cost basis for Apple is $3.90. So your break even, Apple can drop another $5 before you break even. Or before you start losing money. And say Apple finishes at 400, big deal. Your shares get called away at 395. You bought it at 395, but you took in $5 of credit. So you really sold Apple at 400. Win-win. You can do things like that. Same thing on this side. You can short, 100 shares and then sell. You can sell the at the money covered put or anything you want. Then you can do credit. You can sell credit. You can just straight sell a call, or you can sell a cash secured put out here. So if you want to add your stock, just sell this 395, and if it never gets there, then no big deal. You take in the credit. Or let's go more risk type trades. Let's say credit spreads, where the money goes away forever type thing. The reason I like credit, well, first of all, if selling puts, I'd way rather sell cash secured puts because you get to just keep the shares and then you can sell calls right against them. So say you sold this 395 puts, stock ended up here, so you had to buy the stock at 395. We'll now go turn right back around and sell the 395 calls on it, keep lowering your cost basis, but at least you get to keep the shares. So with a credit spread, because a lot of people can't do cash secured puts, one contract's $40,000. So on credit spreads, I like them so much more than debit call spreads, is for just a simple commission reason, and they're much easier to maintain because they just expire. So say you sold this credit spread, you sold the 395 strike and you bought the 390 puts, and say you sold that for 50 cents. The exact opposite trade with the same effect would be a debit call spread. You would buy the 390 call and you would sell the 395 call. And so the thing though with a call is, or what did I say, a debit spread versus a credit spread, is a credit spread you can just let expire. You don't have to do anything with it. If Apple, finishes right here, you just let it go. You don't do anything. With a debit call spread, you're going to have to close it out, or your broker may close it out. You're gonna have to spend the commissions. So there's more maintenance involved with doing debit. So, but if you can't wrap your head around the credit, or you just don't like the concept of it, then just do the exact opposite. Just do it in the money debit call spread. It's fine. I think credit spreads are just much superior. But that's another thing. Opposite's true up here. You can sell a credit call spread. You can sell the 410 calls, buy the 415 calls, or the exact opposite and buy a debit in the money put spread. Same effect, but you're going to have to close it out in the commissions. Another thing people will talk about, like risk reward, or have some arbitrary number like, oh, 20 cents isn't enough. I need to get at least 50 cents, or I need at least 50% return on my money. Look, I have this in this portfolio model, and this is a credit spread account. And so this is 5 trades. It's 5 months. It's 1 trade a month. I split them up to just do all by half position and then half position. But ultimately, it's only 5 trades, 5 months. And if this ends up, if I end up with 100% gain on this month, this will be a 50% return in 5 months. But look how I took in 45 cents, 54 cents, 39, 42, 23, 38. See, I don't care. I care about probability versus some arbitrary, you need to get at least 12% return back. No, I don't care, because it adds up to real money. The thing is not losing money, because it's so hard to come back from a loss. When you lose $1,000, now you got to go gain $1,000 just to get back to break even, while this guy is just slowly accumulating it. And so all this money adds up to, a decent reward. And usually per annum, getting about, being very conservative, like this, this credit spread account right here survived Steve Jobs stepping down as CEO, Steve Jobs leaving, all the Greek stuff. It survived all that. And, usually you're getting pretty conservatively about 100,000, you're getting about 100% per annum return.